metamorphosis. And the changes we're seeing right now, driven by technology, are happening before our eyes, and the changes we're seeing when it comes to virtual currencies are really just one aspect of that. Broadly speaking, I think these changes are resulting in really a fascinating collision between two very different things. And one of those things is the very tightly regulated world of banking, and it's colliding with the very unregulated world, largely unregulated world of innovation, of tech. And I think what we're all working through right now, as an industry, but also as regulators, is how that collision is going to work itself out as we go forward. And the debate over regulation of virtual currency is really just one aspect of that larger collision and how it's going to work out. I'll tell you, where I work at the Department of Financial Services in New York, virtual currencies got on our radar screen for a very simple reason, which is we regulate money transmitters like Western Union and MoneyGram. But as you might imagine, our statutory scheme was put together and written long before there was an internet, let alone virtual currencies. So our initial focus last year when we started looking at virtual currencies was how to deal as a regulator with virtual currency entities who might be engaging in money transmissions, which would mean the department, our department, has a specific legal responsibility to license, examine, and regulate those firms in New York. Now, indeed, those responsibilities go to the core safety and soundness work that DFS does as a regulator to protect consumers. And moreover, there have been very serious and documented concerns about the use of virtual currencies for illicit activity and for money laundering. The Liberty Reserve and Silk Road cases are perhaps the most notable examples, but sadly, I'm sad to say that this illegal activity has only grown since those cases were brought. So in August 2013, our department launched an extensive inquiry into the appropriate regulatory guardrails to put in place for virtual currencies. Now, let me just step back for one moment. I get asked a lot by people who are not in this room, people who are not in this world of payments and technology and virtual currencies. I get asked, why does any of this Bitcoin stuff matter? And for those people, it's a fair question because they still don't comprehend what Bitcoin is, and they certainly don't understand what it could offer in the future. But I can tell you that in New York, at our department, after we began looking into virtual currencies more closely, it became very clear to us that the power behind the technology is pretty amazing. And I don't think any of us knows exactly how virtual currencies are going to shake out over the next few years. The tech is obviously going to continue to change and evolve and likely improve. And platforms are going to be built upon platforms. And probably the most interesting and successful utilization of virtual currencies haven't even been imagined yet. But it does appear that at the very least, virtual currencies hold the potential to provide several important things that I think you all are quite familiar with, like one, much cheaper fees for transactions, two, frictionless transactions all over the world, even into countries with no modern banking system, and all of this with far less potential for identity theft. And those are just some of the basics. Programmable currencies, of course, hold many interesting potential applications and efficiencies. And it's also worth noting that virtual currencies, if they continue to take off and become more popular, that they will challenge to some extent the payment systems that exist at our largest banks. And that could cause those banks to really up their game and improve their own payment systems, which would be a benefit to all of us. So to be clear, at DFS, we think that virtual currencies matter, and we're excited about the potential that they hold to improve our system in various ways. As I mentioned, virtual currencies can, of course, be abused. But that's, of course, true of our traditional banking system, where we have at times seen fraud, money laundering, etc., at some of the world's largest institutions using good old fiat currency and doing it on a massive scale. Now, in January of this year at DFS, we held hearings on virtual currencies with the hope of getting really a 360-degree view of this new and constantly evolving industry, both its promise and its potential pitfalls. We sought to bring together a diverse group of witnesses with an array of different perspectives. We really believed that it was appropriate to hear from law enforcement and regulators, but we also wanted to bring in investors, technologists, merchants, and a number of other individuals on the ground floor of this fledgling industry to provide their views. Now, those hearings, as well as our broader inquiry into this area, not only taught us a lot about the industry, but it also sparked a lot of debate, a lot of healthy debate. And we certainly benefited from that debate, which is still going on today, because the regulation of virtual currencies requires us to come up with appropriate guardrails, as well as licensing, examination, and collateral requirements, while at the same time not stifling innovation and not crushing a fledgling industry. So, as we were proceeding with our inquiry after the hearings, we initially thought we would take our time and put out an initial proposed regulatory framework by the end of this year, the end of 2014, for public comment. However, the collapse of the unregulated virtual currency exchange in Japan, you all know as Mt. Gox, a company at which millions of dollars worth of consumers' Bitcoin essentially vanished overnight, made us accelerate our timeline. That event, the collapse of Mt. Gox, underscored for us the risk consumers run when entrusting their money to an unregulated financial institution, whether for Bitcoin or for any other financial product. In other words, that is precisely why we have financial regulation. Now, we're not fooling ourselves. It is impossible to fully eliminate all the risks financial consumers face, and there have been times when regulators have fallen down on the job, such as our last financial crisis. But effective and appropriate government oversight can play an important role in reducing the risks of fraud, mismanagement, and abuse for financial consumers. Moreover, as some segments of the Bitcoin community itself have noted, poorly run exchanges and the doubts they foster among consumers are a serious threat to the wider adoption of virtual currencies. And when Mt. Gox collapsed, there was no regulatory body ready to step in and get timely answers for consumers. Instead, there was radio silence. I can tell you the day Mt. Gox collapsed, I know exactly where I was. I was in Basel, Switzerland, at a meeting of international financial regulators, about 20 different countries represented, and I got a call from my office telling me what had happened with Mt. Gox collapsing. And at a break of that meeting, I took aside the Japanese regulators and offered our assistance. I said we would put our virtual currency team, some of them on a plane to Japan as soon as they wanted to help them. Unfortunately, the Japanese regulators had no idea what I was talking about, and that underscored for me the dangers when a large financial entity goes totally unregulated. Now, ultimately, after the Mt. Gox collapse, we redoubled our efforts and put forward our proposal for public comment 6 months ahead of schedule in July of 2014. That regulatory framework included a number of key provisions to safeguard customer assets, protect consumers from fraud, root out money laundering and other illicit activity, and put up strong defenses against would-be hackers by emphasizing the need for robust cybersecurity. Now, to be clear, our proposal was meant as a beginning, not an end, to a healthy, vigorous public discussion about what the final regulation would look like, and we certainly got that. Well, we wanted to move quickly to put in place rules of the road for virtual currency firms to provide greater clarity and certainty about the regulatory environment, but not move so quickly that we risk mistakes. To that end, while we put forward our proposal for public discussion ahead of schedule, after some members of the virtual currency community asked for additional time to formulate their feedback, we listened and we doubled the length of the initial comment period. Indeed, I think there may have been some people who mistakenly assumed that our initial regulation was a take it or leave it, all or nothing proposal that would take effect in a matter of days or weeks. Actually, when we do regulations, and especially regulations in areas of entirely new technologies, we engage in a very iterative process, and we like to have a robust give and take. It's just vital to getting things right. Truth be told, public comment periods also generally take a good deal of time in government. So we are likely to make some additional changes to our initial proposal and clarify other provisions. And state law provides for an additional comment period when an agency makes new changes to a proposed regulation, which should provide a further opportunity for public feedback. So our public comment period has now ended. It ended on October 21st. I would anticipate that we'll have a new draft of the regulation around the beginning of December. And that will then trigger another 30-day period of comments, which we look forward to. And I would assume we would then have a final regulatory framework, final, sometime early in 2014, hopefully in January. Now, while we'll be making substantive changes to the regulation, and we very much appreciate the time so many people took to formulate and submit comments, I've read many of them myself, and I can tell you many of them are excellent. We do think that many of the original proposals make sense, are good for consumers, and they are good for the long-term health of the virtual currency industry. The rules also generally mirror the types of requirements that other banks, financial institutions, and money transmitters have to live by, with some alterations owing to the unique nature of virtual currencies. Now, this is a point that is not well understood, in part perhaps because virtual currencies sit at a crossroad, as I mentioned, of the more lightly regulated technology sector and the more heavily regulated financial sector. There is a basic bargain that when a financial company is entrusted with safeguarding customer funds and receives a license from the state to do so, it accepts the need for heightened regulatory scrutiny to help ensure that a consumer's money does not just disappear down a black hole. And most of what Bitcoin firms are being asked to do, whether it is examinations, anti-money laundering compliance, accounting, or record keeping, is similar to what other financial firms must do. Additionally, we agree with the sentiment that financial regulation should be, wherever possible, and to the extent practical, technologically neutral. But we can't stick our heads in the sand about the fact that when it comes to consumer disclosures, capital accounting, and other issues, there are certain real differences between fiat currency and virtual currency. What we should do is endeavor to make sure that where there are technologically specific regulations, they are as narrowly tailored, reasonable, and warranted as possible. Moreover, to the extent that there are some specific areas of the regulation that are somewhat stronger or more robust for virtual currency firms than we have for other financial institutions, and I think I'm talking here mostly about our cybersecurity rules in the proposed reg, that is primarily because we are actually considering using the cybersecurity rules in the Bitcoin reg as a model for the rest of our regulated institutions. I think, as evidenced by the recent JP Morgan hack and numerous other hacks we've seen, cybersecurity is rapidly becoming one of the most important issues any regulator, and I think, frankly, the financial system will face over the course of the next year or two. And you'll be hearing a lot more from our agency about this. I think you'll be hearing a lot more from a lot of different agencies about this. In a Q&A we're going to have, I'm happy to separately discuss cybersecurity and what needs to be done there as much as you'd like. Now, as I noted, there are some important changes we're going to be making to the proposed regulations, many of which I expect will be clarifying in nature. We've discussed some of those expected changes recently in public, but let me just outline them briefly here as well. And I also want to add a few new additional changes we're considering. First, there is some confusion about who will be required to obtain a BIT license. For example, some believe that our proposed regulation will require all software developers and all individual users of virtual currency to obtain licenses. So let's be clear about this. We are not regulating software as software. We are not regulating software development. For example, a software developer who creates and provides wallet software to customers for their own use will not need a license. We are regulating financial intermediaries. That's what we're supposed to be doing. We are not regulating software development. Let me repeat that one more time. We are regulating financial intermediaries. We are not regulating software development. Now, individual users are similarly exempt from the license requirement. People who want to use virtual currency to make purchases or want to hold virtual currency solely for investment purposes will not be required to obtain a license. And we'll make all of this clear in the revised reg. Second, there appears to be some concern that virtual currency businesses will need to get several different types of licenses, resulting in a cumbersome and duplicative application process.
To the extent an applicant requires both a money transmitter license and a virtual currency license, for example, which could be possible in certain circumstances, the process will be streamlined. Applicants will be able to cross-satisfy the requirements of each license. Third, we have received comments claiming that banks are completely exempt from complying with the virtual currency regulations, and that is not fair. That, of course, would not be fair. However, it also isn't true. The banks we regulate cannot start providing virtual currency service without prior approval from the department, and they will have to comply with any requirements that are otherwise imposed on virtual currency businesses. Now, fourth, there has been much speculation about whether we intend to regulate mining. Again, I want to be clear about this. Mining and mining pools per se will not be regulated. To the extent a miner engages in other virtual currency services, however, for example, hosting wallets or exchanging virtual currency, a license might be required for those activities. So those are some of the changes we've previously outlined, but let me address one new additional area that I think is of great interest to at least some of you. One issue we've heard about consistently throughout the entire comment period is a concern about the compliance costs of regulation, especially for new or fledgling virtual currency enterprises. Now, this is a difficult issue, and we've been wrestling with it for months. There has to be a way for startups to start up and to play by the rules without getting crushed by huge compliance costs. To that point, we are considering creating a special type of transitional bit license, which would allow certain small businesses and startups to operate within a more flexible framework for a set period of time, during which time tailored examinations would be conducted. Now, in other areas at DFS, we have at times exercised some flexibility to tailor the types of guardrails and protections we put in place based on the risk profile of an individual firm. We see the benefits of doing something similar here. In considering whether or not to grant a transitional bit license, we could consider, among other factors, the nature and scope of the applicant's business and the associated consumer risks, anticipated transactional and other business volume, whether the entity is registered with FinCEN as an MSB, and the mitigating risk controls already in place, for example, a bond or other insurance. Now, to be clear, we will not waver in our commitment to protecting consumers and preventing illicit activity. We can't turn away from the vital task of preventing money laundering, which sometimes facilitates truly unspeakable crimes. And any firm that engages in misconduct will face real penalties. Moreover, firms will still have to meet strong standards for consumer protection, anti-money laundering compliance, and capital standards. But for example, they could potentially, a small startup could potentially use an outside vendor rather than a separate internal compliance officer for certain functions. We're also considering at DFS designating a specialized group of examiners to handle the licenses and applications for startup firms. That will give that group of examiners some expertise and some real understanding of what startups are going through and will enable us to more appropriately hone the transitional bit license in a way to allow those firms to get through the process. Ultimately, we will continue to strive to strike an appropriate balance in virtual currency regulation that helps prevent conduct that is harmful to consumers and public safety, while still permitting beneficial innovation to proceed. And it is our hope that innovative new companies committed to doing doing things the right way will want to do a lot of business in New York, the financial capital of the world. Companies can, of course, try and run from regulation in a race to the bottom, to set up shop in dark corners of the globe with little to no oversight. I can tell you personally, I find it depressing and dismayed to hear some companies threaten to not do business in New York simply because we believe there need to be regulatory guardrails. Some firms will even play one regulator off another to try and water down the rules, a process we call regulatory arbitrage. We saw this phenomenon a lot during the lead-up to the financial crisis. But our hope is that companies recognize that effective, appropriate regulation will help create a race to the top. That smart, tailored regulation will foster greater trust and confidence among both customers and investors who want to do business with firms committed to consumer protection. And that will spur a virtuous cycle of greater adoption of virtual currencies, a cycle where it is possible to innovate, make a profit, and play by the rules all at the same time. So at a basic level, our guiding principle for virtual currency regulation is similar to our guiding principle for regulation at all financial companies. We have never been an agency that supports regulation for regulation's sake. We simply want to make sure the appropriate guardrails are there to protect consumers, and at the same time we help prevent illicit activity. When it comes to safeguarding customer money at a financial company, an unregulated world of caveat emptor has never been a sufficient answer. Now, right now it seems that the virtual currency industry is at a crossroads regarding whether it will become an important part of our financial system in the future. At DFS, we're committed to proceeding thoughtfully, since virtual currency could ultimately have a number of benefits, as I've outlined, for our financial system. Events and discussions like this one really help as we strive to right-size and modernize our regulation of new financial technologies like virtual currency. I very much look forward to getting your questions, to learning more from all of you today, and I want to thank you for the opportunity to speak with you today, and I really look forward to our give and take. I want to now ask Jacob Farber, I think, is going to come out here from the law firm of Perkins Coie and help moderate the Q&A session, but I very much thank you for your help.
Hello, everybody. We have about 19 minutes, so in order to make sure that we have a productive discussion, we're going to ask that we keep questions as short as possible and avoid a lot of editorial content. There are 3 microphones, one in each of the 3 aisles, so if you have a question, please come up to the microphone closest to you. Before you start speaking, please give us your name and your company name. And don't everybody rush to the stage.
To the extent the language goes further than that, and there's other language that accomplishes everything we want to accomplish, wide open to it.
Last comment, if I may. I suggest to you that you will find that language, in light of cases in the last 9 months, actually produces constitutional questions.
Folks, just a reminder to keep things going. Let's have questions and less editorial comment, because we don't have that much time left and there's several people lined up. Sir, in the middle.
My name is Mark Smith. I'm the founder of Math Money FX. I have 18 years experience in traditional fintech.
Where are you from?
I'm based in Manhattan. My question is, what industry insiders did you use to help formulate the initial bit license structure? And then secondarily, was there ever a thought that instead of using the power of the state to regulate, to reach out in a public-private relationship and build an SRO with industry insiders that might be better adept at being able to regulate this industry?
Let me take the second question first. No.
There you have it.
But you know, it's just, we didn't do that. It just wasn't the path that we were on. On the first question, it was one of the reasons we held 2 very long days of hearings. And sort of a good impact of holding an extensive hearing is you have to spend a lot of time getting ready for those hearings, so you know what you're talking about there. And in the month or so leading up to the January 14 hearings, we spent a lot of time with various different players from all angles of the community. Then we had the hearings and we learned a ton, not only from the back and forth of the hearings, but also from the written submissions we got. And we got a lot of written submissions from people who didn't testify, which we also read. And then since that time, until, that was January, and then until July of 14, when we put out the proposed reg, I think the team, we have a team of about 15 people working on this now. They were having meetings almost on a daily basis with numerous players in the industry. I bet some of them are probably here today. So we took a lot of comments. Doesn't mean we let anyone else write the regs. Our people wrote the regs, and that's, I think, appropriate and how it should be done. I've seen other institutions who don't do it that way and have an initial draft come from the industry, let's say. I don't think that usually works out for the best. And the good news is we have a real back and forth and a give and take. And I think when you see the next revised version of the reg, it's getting more and more honed and hopefully smarter and better. And go from there. The good news also is, if we don't get it all right, and we don't pretend to have a monopoly on the truth and to always be perfect, we're not above course correcting where appropriate. So I think, look, we take our job to prevent money laundering, to protect consumers really, really seriously, but we're not so dogmatic that we're not willing to make changes where certain aspects of the reg, once we put it into effect, if they're not having the impacts we think they should have, or if we see some unintended consequences, which regs always have, we can address this. Thanks.
Thank you. And over here?
Superintendent, thanks again. John Beccio with Circle Internet Financial in Boston.
We've met.
Yes.
This is one of the guys I met with.
I was going to say thank you very much because it's been a very transparent and collaborative process, and I appreciate you working with industry. My question is specifically on the AML provisions, and if we may see some changes in the next iteration of the proposal, especially with those provisions in the rule that differ from the federal standards, and those provisions also that might also be very challenging for industry because of the technology behind Bitcoin.
Yeah. On so there's two aspects to your question. On the changes that we might or might not make to make them consistent with the federal regs, I don't know that we're going to do that, but we're still working on it. But on the question of asking for certain AML information or KYC, know your customer information, that may be literally impossible for a firm to do, that's something we're wrestling with right now. Obviously, we're not going to ask firms to do something they simply can't do. And but what we're working through is, what is that exactly that can't be done? And we get it, especially when it comes to information about the recipient of a transaction. Obviously, when you onboard someone, you're getting a fair amount of information from them and can understand who they are and what they're doing. When that money is, or virtual currency is then flowing to another place, we get that you have IP information and you have identifying information given to you by your customer, but asking you to try and verify that may be a fool's errand. So again, we're thinking long and hard about that, and the comments you guys have submitted on that have been excellent.
Thank you. You guys have been waiting over here, so let's try and take two from this side.
Hi, Joe Colangelo from Consumers Research. Superintendent, how, if at all, has your understanding of Bitcoin, the technology behind Bitcoin, evolved since you first put together a proposal? And second, what kind of role do you see multi-signature technology playing in protecting consumers in the state of New York?
My view of virtual currencies, Bitcoin, digital currencies is constantly evolving. On the airplane flight out here, I read the latest Economist, which had an article about everything that's happened since the Silk Road and Liberty Reserve case, and it scared the heck out of me. And at the same time, the more we study it, the more we realize that technology is very, very powerful and could really come from New York, where, for example, you've got a huge community of people that at the end of every week go to Western Union or MoneyGram and send a ton of money home to their families in another country. And they're paying 8 to 9% right now to do that. And these are people who really can't afford 8 to 9%, but they have to pay it, and they're committed to sending that money back home. And virtual currencies, for example, hold a real promise to bring that number, that 8 to 9%, way, way down. And that's incredibly powerful. And I think, again, the more you study the different applications, I think the more you realize that there's some real there. But it's just a question of, you have to look at the other side too, which is when you see what's going on with all the new Silk Roads. And I think the next speaker after me is going to talk a little bit about that. You have to be able to address that too. That's the fundamental evolution, but also the fundamental problem we have, which is trying to square those two things. I'll talk to you after about your multi-signature question. Sorry, I forgot it. Second part.
My name is Noah Berger. I'm with XP Teller. I'm curious, you mentioned that you have about 15 people tasked with the BitLicense, and the people of the state of New York are sort of, the people you're trying to protect. I'm curious, one, how much of their tax money has gone to fund this BitLicense from prior to the January 2014 through now, and how, before you began your investigation, how many outcries did you get from your population in New York that were asking for protection from your department?
Sure. So zero. We've spent zero money. We have a general budget of our department, and we get that whatever we do. And our job is to spend our time, and my job is to make sure that the 1,400 people that work at the Department of Financial Services in New York are doing things that make sense and matter. And we made a determination that this potentially could be a quite significant development in the fintech world. And because it involved money transmission, we had an obligation, frankly, to deal with it. So we did that, but I guess there's a transaction cost of taking 15 people who could be working on something else and having them work on this, but it costs the taxpayer nothing additional. In fact, our department, just so you all know, is not funded by taxpayers, it's funded by assessments on the banking and insurance industries. So individual taxpayers get a pretty good deal with us. What was your second part of the question? Oh, outcry. Look, we don't usually get an outcry for specific things like this, but I think, look, you want to just talk broadly, right? Money laundering. Terrorism doesn't really thrive anywhere in the world without the ability to move massive amounts of money around the world. And so I think that a lot of New Yorkers and a lot of Americans and a lot of people around the world want regulators and want prosecutors that care and prioritize and do something about money laundering. So I think generally, again, no one called up and said, hey, you need to do something about this particular problem. But I think generally we're aware that people want good, strong anti-money laundering regulation, not just of the virtual world, but of traditional banking as well. And then you could go down the list of other issues, both negative and positive, related to fintech. And I think it's clear that people in New York and people elsewhere would want a regulator working on this.
Superintendent Lawsky, I think we're pretty much at time. You want to take one last quick question?
Why don't we take 3 real quick?
All right, sounds good.
I'll talk fast.
All right, so let's go over here.
Superintendent Lawsky, Carol Van Cleef of Manat, Phelps and Phillips.
Testified at our hearings.
Thank you. I'd like to seek clarification of your comments with respect to the banks. You indicated the banks would need approval. Do you intend to have them go through the licensing process, or will be approval in your ordinary course of supervision of the banks? And second, is that your comments directed solely to, are your comments directed solely to banks that are chartered by the state of New York? Does it include banks chartered under laws of other states? And what about national banks?
That's a great question. So I think our intent is, if a bank is going to engage in virtual currency business, that they will have to meet all of the same requirements that we're requiring of traditional virtual currency businesses. I don't know whether that means they would have to get a license, because they probably already hold other types of licenses that could qualify and we could cross-apply. But if they don't, then I don't see why they wouldn't need that license. Now, your second question, would it apply to non-New York banks? I would say if it affects New York consumers, yes. If you then have a preemption question on the national banks, I still want to say yes, but I want to reserve the right to ask my counsel.
Fair enough. So I think we're going to have the last 2 quick questions. Let's not compound questions, we can get both in. Thanks.
Hi, my name is Max Hartman. I'm a recent Columbia College grad, which I understand is your alma mater.
Go
Right on. And really
terrible
quickly,
football team this year. Terrible.
Well, it's always terrible, and I really appreciate your level of engagement with the community, both at events like this and also online, like on Reddit and etc. I'm a big fan. I wanted to get your opinion on what you thought about like peer-to-peer exchanges like local Bitcoins and like Mycelium.
How to react? Well, first of all, my chief of staff is going to pay you for all those nice comments as soon as you walk out. Peer-to-peer exchanges?
Yeah, are you familiar with like localbitcoins.com? It's like the largest global peer-to-peer exchange.
Yeah, are you asking whether they would be regulated? You're asking just sort of my general reaction to them?
Both. I mean, should those be regulated? Do those fall under the same kinds of, should those fall under the same regulations as a larger, more centralized business like, well, I won't name names, but the largest ones here in the United States and abroad?
Well, I think that to the extent that peer-to-peer exchanges are acting like exchanges, they're going to be regulated like exchanges. Peer-to-peer transactions may not. And I think, I don't want to get too deep into this because I know we're out of time, but I think that's going to be the rub and the tricky question we're going to have to figure out. I'd have to learn more about it.
Thank you.
Thank you.
Hi, my name is Stan Higgins. I'm a reporter with CoinDesk. Do you think that non-financial blockchain applications like smart contracts, digital asset distributions, do you think that there should be a BitLicense framework for those applications, or do you see that regulatory process playing out?
So that's a very interesting question. I think if it's a purely non-financial transaction, let's say using the blockchain, is that what you're asking?
Yes.
That wouldn't fall within what we're trying to regulate because it's not a financial intermediary. The tricky question, I think, becomes, I've seen some of those businesses and companies, when they're doing those types of transactions, require some small de minimis amount of actually financial exchange to happen, say a penny. And so there's a tiny financial transaction allowing something that's totally non-financial to happen. And the question is, how do we regulate that? And we're working on it is the answer, but that's a very tricky thing. And our intent is not to regulate non-financial transactions.
Thank you.
Great question. Superintendent Lawsky, thank you for your engagement with the community. Thank you for all your questions.
Thank you, Superintendent Lawsky.